Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, June 9th, a couple minutes before the close. Where did all that volatility go in the equity market? People look at the VIX as a signal of volatility, and that's been falling precipitously. In terms of what that means to the market, it let the market continue to breathe. You see breath spreading out. Small caps and mid caps doing better. Value getting a little bid. Remember, the QQQ NASDAQ 100 has been scorching all year. Value's been quiet. As a matter of fact, at the beginning of June, if we were looking at the equal weighted S&P or value ETFs, they were flat, some down a tick or two year to date, with at that time the S&P up 8%. So it's nice to see those areas get a bid. I do have an interesting chart for you. And you know what I always say about charts. If I'm negative on the market, I can show you 3 charts showing why I should be negative on the market. If I'm positive on the market, same thing. I can show you 3, 4, 5 charts showing why I should be positive. The key in the markets is to lean against your opinion and have respect for the other side of the trade. That said, I want to bring up an interesting long-term data graph. What we're looking at here is years in which the S&P 500 has returned greater than 10% during the first 6 months of the year. Now, since 1928, the S&P generated positive 10% returns during the first 6 months 27 times. So over 103 years ago, let's call it 25% of the time, the S&P has had good solid performance in that opening half of the year. Interestingly enough, 3/4 of the time, the back half of the year, so July through December, was also positive. Obviously, that means 25% of those years was negative. Here's the interesting part. Even in those negative years, there was only one time where the performance was poor enough in the back half of the calendar year to create a negative return for the year. That shocked me. You probably find that interesting as well, but it does go to show that momentum and trend can get sticky, and we can see that on the downside as well as the upside. I bring this chart up for a reason. We have conversations every day, all week, all month with clients and friends in the market. I continue to have conversations with people that are very negative and fearful in the market. For all I know, we can be in front of a very poor back half of this year equity-wise. But I think it's important to respect history. If you're negative on the market, at least factor into your thinking what has previously occurred in returns on an annual basis. We talk about this all the time. What can go right? What can go wrong? Where you get stuck is when you fall in love with an opinion and can't get off it. So we'll stay flexible, still have cash in some of the strategies, did put some money to work, even took a little off the table in our tactical strategy in Adobe. Had a big run, just paired that position a little bit. So we'll see what comes up next week. John Mousseau filmed a video for you yesterday. John, take it away.
Thanks, Matt. We're taping a little earlier this week when we're looking at the bond market. This week, not a whole lot of change. We're in the Summer Doldrums. Saw the 10-year bond up 5 ticks, 375-ish. You saw the 2-year bond basically at a 450, no change at all. As we sit here, we did have a higher number than expected on jobless claims, 260,000. That continues to climb up. It has been 2 steps back if you think about higher jobless claims and 1 step forward, but it's been inexorably running higher, and that's what you would expect with an economy that is slowing down. We think this trend continues as you go into the second half of the year. We have lots of different anecdotal signs out there, not just jobless claims, but we look at commodity prices. You've heard us talk about the commercial property overhang in many of the big cities. You're starting to see some softness in residential real estate. Oil prices have stayed low on a relative basis. So all of this leads us to think that the Fed, which will be meeting next week, and we'll be looking at the CPI data that we'll all be looking at, they may not pause next week, but pause is in the back of their mind, no question. And we think that if they continue to go, you're just going to continue to see it bite more into the economy. There's no question that if they paused at 5 to 5.25, or if they hiked to 5.25 to 5.5, the point of it is the longer it stays here, the more cumulative the bite becomes, whether it's somebody trying to refinance something or taking out a car loan, looking for a mortgage, etc. And that affects, across the board. On the municipal bond side, we saw good demand for deals this week, really no change in pricing at all. Yields didn't move. Another sign that the summer is with us. We hope everybody has a really good week.
Thanks, John, and get some rest. It's going to be a busy week in Bondland next week. John also wanted me to pass along his Belmont pick, Angel of Empire. Remember 3 weeks ago, National Treasure won the Preakness. John and I both liked that horse. He's back in the Belmont. And believe it or not, I'm on Angel of Empire as well. So Moose, good luck to you. We'll see what happens. Have a great weekend.